Welcome back. We are talking Monetary Policy Committee decision, and we're discussing, to help us discuss this is Abraham Mudogo Kamau, who is the CEO of Miradi Capital. Abraham, welcome once again. You obviously had time to look at the press communique yourself.
Yes, I have.
Any surprises in the language?
No, actually not. First and foremost, nobody expected CBR to move,
yes.
And sure enough, it did not. But then again, most of the things that have been said here are basically things that you and I would know very easily without having to read it from here.
Yeah.
But that said, I think...
so it's more of what is not here?
Yeah, it's more of what is not here.
Okay.
So what is not here?
What is not here, for example, is what is what is the correlation between demonetization and the runaway forex?
Yes.
Forex rate. Here they're saying we are stable, but in a short period we moved from 100 to 104.
Yes.
And we are playing 104, 103 now.
Yes.
So there is pressure, but there's been no attempt to explain where that pressure is coming from.
They've avoided it.
We've just spoken about our import cover, and we've spoken the forex is stable, the demonetization is going. But these three are actually related. But nobody has made that attempt.
How do you see, how would you tie in the correlation? So is it demonetization is driving liquidity and people are running to hold hard currency, or how would you?
I would say that, of course, especially people who don't want to come through the front door.
Okay.
They would rather now change their assets to dollars.
Yeah.
And as much as that is not done in the open market, the pressure will eventually show.
Yes.
And I think that would probably inform why they have avoided that subject. Because if they try to correlate this, then they have to go into that kind of explanations.
Yeah.
And sometimes it's also very hard to quantify an unknown. If you don't know something, it's very hard to talk about it.
Yes.
Although you have every indication that it is happening.
Yes.
Yes.
That's a very interesting. It's a very interesting emphasis. They talk about narrowing of the current account deficit. It's for me. It's all because some of the heavy machinery that is related to SGS construction, those importations died down. But we're not seeing a corresponding growth in exports. Does that concern you?
It does, because you see, you cannot shrink yourself to greatness.
Yes.
and that's what we're trying to do. You see, if we cut our exports, we are still an import-driven economy.
Yes.
So there are certain exports that are critical, if not essential, to this economy. So I would rather the current account deficit is reducing on the back of exports.
Yes.
That would be fine.
That's more sustainable.
Yeah, but this other one, of course, you can only cut so much. And then it will stagnate and then go back up.
Yeah, that's true.
But what about just the element of diaspora remittances? Because I can understand when you say that the reduction is not necessarily a good thing. But then when we come to the FX market and you're looking at the FX reserves and the continual increase in diaspora remittances, doesn't that give the CBK governor and the central bank in general a lot more headroom to be able to just weather any volatility that would come? In fact,
and that's what we were discussing with my Buroji here. If you look carefully, I tend to think CBK is intervening.
Yeah.
In a small way.
Yes.
Yeah. Because and also they're able to hold it at 104 because the pressure is there. So in terms of the remittances coming, and you see we've got 6-month cover.
Yes,
so we're not short of forex.
That's true.
So we can we can put it at whatever we want.
Yeah.
So maybe CBK is okay with 104.
Yeah.
For now, but I think it's something they need to put a lead.
Can 104 is a new level? We were so used to 100.
Yeah, we were so used to 100. Maybe they want to correct it to 104.
Yeah.
Because I think they look comfortable because making this kind of statement, and they made it on the back of 104.
Yeah.
It's
probably they're endorsing it.
Okay. Actually, they've actually recently brushed it off.
Yes, it's what I'm saying. So to them, it's a non-issue.
Yes, a non-issue.
So if it's a non-issue, it means then at 104 it's okay.
Okay.
Yes.
But let me go back to this issue. So I'm wondering, okay, maybe they're comfortable with 104, maybe they're not. And of course, there's the continued conversation that it is a weakness is inevitable. We just don't know at what point in time. From your own analysis, given that they have 6.2 months cover, diaspora remittances are increasing on a month-on-month basis, what would be the triggers that would actually cause a run on the FX?
You see what would cause a run on the FX is one, towards especially the last few days.
Okay.
There'll be those who actually have legitimate money but have been sitting on it, and they will now start coming through the front door.
Yeah.
And and the demand for forex will go high. Again, and coupled with that, now, you see now we've just done our end of year budget.
Yeah.
So now we're going to the new year. So you'll start seeing again the imports going up.
Yeah.
And the first that will start getting depleted is this cover.
Okay.
Yeah.
You see, this cover. Yeah. So now when the pressure on the quantum of dollars we have starts setting in, but the only thing that would stabilize that, again, is our heavy diaspora
remittances.
Yes.
Yeah, and I think we've said here before, I think it's high time we accepted that is our biggest income earner, which it is. And start making
labor export.
Yes, and start making conscious decisions and policies to encourage and facilitate easier movement of that money. Because don't forget, even what they report is probably half of what actually comes.
By the way. The unofficial channels also still.
And you see, and how do we know that those unofficial ones are what are supporting us?
Yes.
You see, all those are unknowns.
Yeah.
Yeah, but looking at the dynamics of a forex market, they definitely play a part.
Okay. Abraham, they didn't mention no mention of fiscal side.
Yes.
I mean, you know that.
That is worrying because see
we have division of revenue bills. The standoff is still there.
Mm-hmm.
You see, and there lies the problem. MPC meets in a room without the fiscal guys.
Yes.
There's no fiscal guy in this room.
Yes. Yes.
So you see, they've done what
they're supposed to be a representative from
Treasury.
Yes.
Yes. So you see, but not with the fiscal strength that is needed.
Yeah.
So once they finish this, now the fiscal guys will also meet, or probably are meeting in another room without the benefit of this.
Yeah.
So if you have to put those two documents together,
I think actually Treasury is represented at the MPC.
Yeah, but do they really come?
Yes, they do.
It is represented, but you see, in here there's no fiscal element.
Yes.
Yes, maybe the decision doesn't have a fiscal element, but it's like saying they look at over 200 variables, but they don't track them. So maybe the question is to ask, what intervention can the MPC make with regards to fiscal? Because I know for sure Treasury sits in these meetings and they make their contribution.
PS Kamau through.
Either the PS or he will send somebody. Or he will send somebody to sit.
And they should, you see, because the PS, the PS finance, I mean National Treasury, has a bird's eye view on both.
Exactly.
That's true.
So he's the one guy who can say, no, this will not fly.
Yeah.
And when I was coming, I just saw there's a new circular again to have more austerity measures from head of civil service.
Really?
Yes. I just read when I was coming here.
Okay.
So there's a move towards that because it is a reality that we cannot continue the way we are doing business.
Yes.
Yes.
But Abraham, do you think there's some element of fiscal side that concern you that MPC should have factored in? Are there things that you're worried on the other side?
For me, on the fiscal side, especially, is on our spending discipline.
Yeah.
That's number one, but more importantly, the pending bills.
Yes.
You know, the pending bills is spoken as a global thing.
Yeah.
But the devil is in the details.
Yes.
Because even if we say it at the center that the bills be paid at the county, that does not trickle down. Even the pending bills at the National Treasury, they're very heavy, and that has impact because those are contingent liabilities that are sitting on us, waiting to spring.
They can crystallize anytime.
Yes.
Okay. They mentioned average commercial banks liquidity at 50.6%.
Yes.
That means banks are keeping money themselves.
You see, this 50
for every shilling, only half is lent.
Yeah. So for every shilling, only 50 cents is lent. Yes. That's what it means here.
Yes.
Because, you know, this high liquidity, of course, is because bonds and bills, treasury bonds and bills count for liquidity.
Yes.
Yes.
That's why it's this high. But at the same time, even being that high, it means 50% goes to government and statutory requirements, and 50% goes to credit. I think that could be better. Yeah. Yeah, because you don't forget the statutory liquidity ratio is 20%.
Yeah. For every shilling they collect.
So there's a whole 30 cents that is going to government.
Yeah.
That is substantial.
So you're not worried about this?
No, I'm worried. I would rather because if you look at today, the treasury, they're trying to push down. They're trying to push down their stock.
Yeah.
Because this is not healthy. Because again, banks are making profit, but what is the production in the economy?
Yeah. Zero productivity.
Yeah. You see, you're just making money, but there's no productivity.
lazy banking.
Yeah,
right?
it's lazy banking, but
Abraham, let me
yes.
ask you just on the same. We
Yes.
keep talking about, like, yesterday we were discussing Central Bank of Nigeria. So
Yes.
what they have done to counter this
Yes.
is they have compelled the banks to have to increase their loan to deposit ratio to a minimum of 60%. So in a way they are forcing the banks to lend out. When you look at this MPC statement and in your own analysis, what interventions would you think the CBK has available to them to actually force the hand in terms of extending credit in spite of the fact that there's a rate cap?
And not even that, let me add actually, now they even issued a new guideline. They told commercial banks that you cannot buy treasury securities for your own book. If you're bidding in the primary market,
Okay.
you need to show a pipeline of clients that...
Oh,
you
when
need to
was this circular?
I think this is like this week.
Oh, wow, I
was
did see
reading
that.
it this
That's
week.
a
No,
big
that's-
one.
that's a game
big,
changer.
that's
Yes.
a game changer.
So they're saying that if you buy
fantastic.
treasury bills or bonds, you better be buying it for clients, not for yourself.
Okay.
And show us that actually show us the clients.
That's a huge game changer.
you see, then
George.
there's
So
this.
they're kicking them even in the primary auctions.
Yeah, so this is
telling
50
them go lend.
So this 50, yeah, because they know this is an obscene figure.
Yes.
50.6. So that kind of intervention will definitely push this down, and that's what we want. We want more money out there. So coming back to the question you've asked about what interventions you can put in the market so that people lend more. There is no other way. We have to push the rate on T-bills and bonds as lower
As
and lower.
So you
as
have a
possible.
negative return and you're compelled to
Yes,
lend
you're
it.
compelled then because we go to what we did in 2003.
Yes.
That formula worked because
What happened there?
because you remember it went to 0.8. Now at 0.8 you're not making money.
Yeah.
Given the inflation.
Yeah.
So banks had no choice.
Yeah.
They're sitting on deposits which they have to pay for.
Okay.
So they were left with no alternative to start calling people and come for that was the advent of unsecured loans. That's what they came
Oh, so
from.
would that explain that, in your view,
Yes.
the element of credit growth going to about 30% of every year? Used to go 30%,
you
40%, 50%?
No, actually at some point we used to do every monthly annual credit.
It was up to 25 to 30%.
Yes.
Would that explain what happened then?
Yes, because
Okay.
because you see, if the current apps for lending are anything to go by,
Yes.
there's massive appetite
Yes.
for personal lending.
They show
Okay,
you.
that's very
So you open that gate and make it convenient. You can't keep up.
Abraham, let's have the market is closed. Let's have a short break
Okay.
and ring the bell and then come back.